time does not necessarily tell you how much money the company has right now. That's what the balance sheet is for. In contrast to the income statement that records transactions in time like a video camera, the balance sheet is like a still camera, showing the company's financial state at a given moment. It provides a snapshot in time that can be used to determine how much the company currently has, how much it owes, and what is left for the owners. The cash flow statement is based on numbers from your income statement and balance sheet, and is like looking at your own checking account. It shows you what the company did to generate cash and how it used cash during a given period of time, often monthly, quarterly, or annually, like the income statement. Thus it answers two questions. Where is my cash coming from, and where is my cash going? Remember, while each statement has a different purpose, all three are necessary in helping us understand a company's complete financial story. For example, if you want to know whether or not a company is profitable, the income statement is what you need. Even though you know the company is profitable, if you want to know how much money the company has available right now that you can spend, you want to look at the balance sheet. And regardless of profitability and current available cash, if you want to know where cash came from and where it went, you look at the cash flow statement. Each document fills in a piece of the puzzle to complete your understanding.
Okay, again, kind of basic, but at the same time, a refresher to for some of us. It's been a while since we maybe have looked at financial statements. What you're going to be doing in case study number 1 is you're going to be picking a company from the Dow Jones Industrial Index, the top 30 companies in America. You're going to select one company and you're going to look at that company over the next 2 case studies and determine certain things about those financial statements and what they tell you. So for example, Yvonne might probably take Disney. She works at Disney. That's a member of the Dow. Jesse might take General Electric's off the Dow. Jesse might take Walmart. Darlene might take Apple. Mr. Salazar might take something, another company. You're going to select one company from the Dow, and in this case study this week, you're going to be looking at the risk of the company, taking a look at the risk analysis from our discussions of Chapter 6. We're also going to look at, in case number 2, you're going to take the same company and do an analysis of their financial statements. A lot what we're talking about tonight and next week. So this is part of the real world application to our analysis, is you're going to pick a real world company. Like tonight, I'm picking a real world company that we're going to look at as far as my lecture is concerned. So we'll talk more about the case study a little bit later tonight, but at the same time, that's what we're going to concentrate this week. So again, I'm going to pull up that spreadsheet that I have posted in Blackboard. Let me get that available here. And here it is. I'll be centering this and getting it a little bit easier for you to read in just a minute. But this is a real world financial statement of a company, a real world. There's financial statements from 2018 and 2019. And for some of you, you can probably pick these apart very easily. Others of you in our class might be kind of difficult. So our job tonight is to understand, like that video just told us, what do these financial statements tell us, not in terms of an accountant who puts together the financial statements, but in terms of a finance person, in terms of a financial analyst, in terms of an investor, in terms of a manager of this company. What does this information that the accountants have prepared for us tell us about a company? And then next week, you're going to be actually picking a company and doing some of this analysis also. So we'll go through this. This is our lecture tonight. But before we get started on our lecture tonight, I want to go over one thing more from our work of last week. And that is on this spreadsheet, the tab Chapter 6. And here it is right here. This might look a little confusing, but I'll explain it. This is summarizing Chapter 6. Now, I had a nice conversation with Yvonne this last week, and she did this for the Disney company where she works. She decided to do a risk analysis of the capital asset pricing model of Disney. All right. You all are going to be doing this in the weeks ahead. So I want to make sure you understand what we mean by determining the risk or the required return from a company. And also, what is the debt risk of a company? And we're going to talk about that. These are both discussed in chapter 6, but the book does a little bit crazy interpretation of some of this stuff and it makes it a little bit confusing to follow. So this is Mr. Hassey's version of risk analysis from chapter 6. And I hope everybody can see the screen. All right, first of all, we're going to concentrate on what is called the capital asset pricing model. All right. Remember, the capital asset pricing model is a formula, is a model to determine the required rate of return that you get from a company. Now, what does that mean? What do I expect to make as a return on investing in this company? All right. And how you determine the risk of investing in this company and the required return is by comparing the company's risk to the market. I'll say that again. Comparing the company's risks to the market. And the formula for capital asset pricing model is this, right up here, the very top portion here. And I'll highlight that for you. The required rate of return, or R, is equal to the risk-free rate plus the market return rate minus the risk-free rate times the beta of the specific company you're looking at. All right? One more time. The risk-free rate plus the market return minus the risk-free rate, and that number is called the market premium. That is multiplied by the beta of the company. Add that number to the risk-free rate, and that's the required rate of return. Now, let me explain this to you. First of all, what did I said a few minutes ago that we're trying to determine the required rate of return for a specific company relative to the risk in the market. The risk in the market is indicated by 3 numbers in this calculation or this formula. The first one is the risk-free interest rate. The risk-free interest rate. That is the 10-year United States Treasury yield rate. And that is considered zero beta. Absolutely no risk. The cheapest form of cash with the lowest amount of risk. Risk-free rate is 0. If I go to the Wall Street Journal today, here it is right here. If I go to the Wall Street Journal today, the very front page, it tells me the 10-year United States Treasury yield is 0.735%. That is the current risk-free rate in the market. Zero beta. 0.735. Now this changes every day. Every day. It's relative to the market. It's relative to what's the cash or the cost of money in the market. It's the zero beta. The next rate is the market return rate. That's the average return for the last, I'd like to use 5 years, but most people use 1 year. It depends on who you talk to. Excuse me. The average market return rate for the S&P 500, the Standard & Poor's 500 index, which is generally considered the market indicator. All sectors of the economy are in that S&P 500. And what is the market return of that number for the last 12 months, let's say? That number is used, but it's subtracted by the risk-free rate to get what is called the market premium. The market return rate minus the risk-free interest rate. That's called the market premium. Be careful of that number there, people. Here's how Mr. Hassey can trick you. I might give you a problem where I give you the market return rate, but I also might give you a problem where I give you the market premium rate. The market premium rate already has that calculation, market return minus the risk-free rate. That's called the market premium. But if I give you the market return rate, then you have to determine the market premium to complete the problem. So those are the two main interest rates: risk-free rate, market return rate. And the third number that we need to pay attention to is the beta of the particular company that you're looking at, the beta. All right. Remember, beta is a statistical regression analysis of the returns over the last 4 years vis-a-vis a particular company to the market, to the industry. Now, we're going to determine the market return, or excuse me, the required rate of return using the capital asset pricing model for Apple Computer. All right, Apple Computer. Now, the rates are a little bit wacky because I'm using an example from a prior quarter, but let's go with it anyways. First of all, I want to determine if I wanted to buy Apple stock, what would be the required return of Apple stock vis-a-vis the market. Well, what is my market? Well, in this example, the risk-free rate is 1.75%. That's the risk-free rate. That's a beta of 0. In this market, the equity or the average market return rate for the market S&P 500 is 9.75%. That's with a beta of 1. And as of in this market, Apple Computer has a beta of 1.1. All right. That's the risk in the market today, or in this example, excuse me, not today, in this example. Now, I will always give you the risk-free rate. You don't have to look it up. I will always give you the market return rate. You don't have to worry about that. But what you will have to look up is the beta for whatever company you're doing an analysis for, and apply that to the formula. Now, how do you find the beta of a company? Very simply. Let me show you. Jesse, you with me? Give me a thumbs up. Thank you, sir. Oh, I got a chat. Oh, no worry, Michelle, I got you covered. All right, let's bring up this. Here's my screen. All right. How do we find the beta of a company? This is a Google. This is my Google Chrome. This is my Google. All I have to do is type in one of the main sources of information that are free, mind you, free. It's called Yahoo Finance. Type in Yahoo Finance, and it brings you up to the site for Yahoo Finance. So I click on Yahoo Finance, and let's say I want to find the beta for Disney. I type in Disney, and up comes Walt Disney Company, DIS. I click on that, and up comes everything I wanted to know about Disney but were afraid to ask. All this kind of financial information. Company outlook, historical data, statistics, profile, financials, but you don't have to go to any of those places. You just have to go to the very front page and look here, beta. Now this is a 5-year rolling average based on monthly. That's how they decided to do it for Disney and for most companies in Yahoo Finance. But I don't care how they calculate it. All you need to know is that the beta for Disney is 1.1. That's the risk of in the market today of Disney. In other words, the risk-free rate has a 0 risk. The market return rate has a 1.0 risk. Disney, a little bit riskier than the market, 1.1. Why is Disney a little bit more riskier than the market with a little bit of a higher beta? Because probably over the last, in this case, 5 years, it's been a little bit inconsistent, just a tad inconsistent to the overall returns in the market, their competitors, the market. And because of that inconsistency, it enables a little bit more deviation in the analysis, if anybody knows what I'm talking about. A little bit more change from the averages. And that little inconsistency in the return of Disney causes it to be a little bit higher risk, not that much more, but a 1.10. So whatever company you pick, you will go to Yahoo Finance and just look up the very front page and see what the current beta is. You might be able also just to type in Google, give me the beta, the current beta of this company. And it might even come up with you that way too. But I wanted to show you Yahoo Finance because we're going to be referring to this a lot over the course of our class as a source of information, free information, all right? The beta, where it comes from. Okay, let's get that out of here. And let's go back. To our problem. There we go. Okay. So that's how you find beta, and I'm sure you guys will be able to find that. And if you can't find it, you can always let me know, and I will point you in the right direction. But we'll talk more about that later. So let's get back to this example of risk and required return from Chapter 6, the capital asset pricing model. So we've determined that the market or the zero or risk-free rate is 1.75. We've determined that the market rate of return is 9.75 and that the beta for Apple, pretty close to Disney, is 1.11. So if I want to put these numbers into this capital asset pricing model, here's what it looks like right here. Let's highlight that and get really high tech here. There you go. All right, here's the formula that we mentioned above. The required rate of return is equal to 1.75% plus the market premium, which is the market return 9.75 minus the risk-free rate 1.75, and that market premium is multiplied by the beta of Apple. So here it is, 1.75 times 8% times 1.11. Do the math. The required rate of return for Apple is 10.63%. Notice, with a beta of 0, I get a return of 1.75. With a beta of 1, I get a return of 9.75. With a beta of 1.11, where the risk is a little greater, I expect a higher return, 10.63%. So what do I do if I want to decide to buy Apple today? I do what Yvonne did in her analysis in the discussion forum, this past week, and some of you else did it as well. You determine what is the true intrinsic value of the stock in the market today by using the constant growth calculation that we talked about last week. You stick that 10.63% number into Apple's computers growth rate and their current dividend and determine their current stock price based on that value of a required return of 10.63. But we don't have to do that anymore. But what we do have to be aware of is how to calculate that expected return in the market, because this leads us to all kinds of other analysis later on in our class. So that's the explanation of that, and you're going to be using this in the coming week in case number 1. All right? Determine the required rate of return. In other words, if I don't think Apple is going to make 10.63% in the next year, I don't think I'm going to buy Apple stock. Also, if I already own Apple stock and I don't think they're going to make 10.63% in the next year, I might sell Apple stock. And guess what? What has been happening in the market the last month with this coronavirus situation, a lot of people are saying, you know what? The companies aren't going to be doing as well in the next year because of this shutdown in the economy. The markets are changing. They're laying off people. I don't think Apple computer is going to make 10.63% in the next year because of the economy now. What has happened to the market? Everybody sells their stock and the stock prices drop because people are selling their stock because, oh, I'm not going to get any value from this stock in the next 12 months. I might as well get out now. Now the market has rebounded in the last 2 days, coming back a little bit. Why? Because people think the government state of California, the state of New York, the nation is getting a better handle on this virus. We're maybe coming to the end of the high point of the virus, and maybe companies can begin to start getting back to work. So why not buy the stock now back into the market when it's a little cheaper and I can make my return? That's exactly what's going on in the market now. People are determining whether the asset, the stock, is going to create value for them based on their expected returns as the indicators of what's the risk of that stock in the market. Huge, huge in financial analysis. Okay, so that's the capital asset pricing model. Let me see if there's any chat questions here. No, okay. Now down here, and again, I'm going to be, this is already in Blackboard. You can see it. I'm just highlighting certain parts of it.
Professor, can I ask a question?
Yes, James.
Sorry to make you go back. Could you go over how you would use those two together again? So if you were to run the capital asset pricing model and then the constant growth equation, how you'd use that together in order to determine a decision?
Sure, good question, James. For example, the constant growth equation is telling you the price of stock today is equal to the dividend that company expects to pay in the next year, and that's divided by the required return rate that we just showed how to calculate, minus the growth rate of the company that they indicate that they think the company is going to grow at in the next year. All right. So if I want to determine whether a stock is under or overvalued today, I can determine what I think the true value of the stock is in the market by taking, all right, the company has to announce every quarter what their dividend is going to be for the next year. The company has to announce every quarter what they think their next 12-month growth rate is, how much they expect to grow. I plug those numbers in with my required return rate that I expect to make, and that will give me the price of stock. For example, I'm going to just use an example here with Apple, okay, knowing what I know about Apple. If Apple says we're going to pay a $1.50 dividend in the next year, all right, that's what they announced they're going to pay, and I have a required rate of return of 10.63%, and Apple has told me they expect to grow at 6% in the next 12 months, I can do those calculations by equals $1.50 divided by 0.1063 minus 0.06, and I get a 0.1063 is 10.63%, 0.06 is 6%. I take $1.50 and divide it by that difference, I get $32.40.
You two are obviously in alignment tonight. Just the two of you. Yeah, that was the plan.
Who's arguing? Okay, they shut it off. All right. So by doing that, James, I can determine what I think is the true value of the Apple stock today, $32.40. I compare that to the price in the market, and is the stock under that price or over that price? That will give me a determination of whether I should get in or out, or if I already own the stock, should I sell? Now, again, these $1.50 and 6% are numbers I just made up, so that's not a true analysis of Apple, but that's how you would go about doing it. That's how it fits into that equation, James.
And the $1.50, what about stocks that you don't anticipate giving you a dividend at all?
Very good question, and I knew that was going to be asked tonight. Let's say some companies say we're not going to pay a dividend this year, or we have no idea what the hell is our growth rate. Then this analysis is null and void. You cannot do it, okay? Now, there's other analysis you can do when you don't know the dividend, but I don't think you want to see that analysis. It's a little bit high tech. So if you want to know about that, I'll show you offline, but I don't want to confuse people more by showing you all the razzmatazz of that. But if you do know the dividend, and again, about 65, 70% of companies pay dividends. And they have to usually say, this is what our growth is. They can't ditch that for a while. You can pretty well come up with a fairly decent estimate. Okay? That's how that works. So this is how the constant growth model that we talked about last week
about 2 years we'll be living together.
fits into the required rate of return calculation here, which is this number here. That's how that works. Okay? Good question, James. Thank you.
Hey, Professor, I got a question.
Yes, sir.
The asset pricing model formula that you have there,
Yes.
different from the one that I've been able to find using other resources. Is this an updated formula, or
Explain those other resources.
the ones I'm looking at? Con University and all these other Wall Street type websites that have the risk-free rate, and then they add the beta and multiply the market return with the risk-free rate.
It's the same thing, isn't it?
I'm trying to.
Because no, notice it's excuse my French, it's ass backwards. Here I have the market return minus the risk rate times beta. There they have risk-free rate plus beta times market rate of return minus risk-free rate. It's the same thing.
Okay. Yeah.
Makes sense?
I'll
Take a look at that. It's just they just put the beta up front here instead of I put it in the back.
Oh, I see. Okay. Now
That's the only difference.
All right. Thank you.
And that can look confusing. I understand how you could get confused about that, but it's the exact same equation. I got a chat question. Let's take a look at that. Yes, you're right, Yvonne. Somebody needs to mute. Turn off your microphone because we're hearing family conversation that I don't think you want us to hear anyways. So if anybody has their mic on, and I can quickly see who that is. Well, they turned it off. That's good. Okay. No, James, you have your mic on. James, you having any family squabbles behind you? Tell the kids to go to bed, have a beer, and get lost. Just that's a joke. All right.
I don't think I had my mic on. I had to. No, I don't think I have a mic on. I did have one follow-up question. The growth rate, is that the one that we're using 6%? That it's given by the company. So are we just deciding to take a look at like a quarterly growth rate, or
no? It'll be 12 months.
Is that always 12 months or?
Yes.
Okay.
For our class, yes. If you want to get a PhD in finance, there's other things to do. But for our class at the MBA level, it's a 12-month rate. Now, let me explain that to you.
That's helpful. Thank you.
A publicly traded company is required by law. They will not be publicly traded if they don't every quarter announce their planned dividend for the next 12 months and announce their planned growth rate for the next 12 months. They cannot get a license to sell their stock if they do not do that. It's required by the Securities and Exchange Commission. Now, most companies spend a lot of money to come up with those 12-month figures, because if they're wrong, people are going to go, well, they always give us BS numbers. Why should I invest in these companies? They're never right. They never can see what they're going to be doing. So it's required by law that companies have to give that information. And it's called, if you look on Yahoo Finance and you look at analysis, you look at analysis reports. Analysis read and look at these quarterly announcements by companies, and they can say whether the company is going to do this or not.
I have a question. Well,
yes,
I have actually some input. A lot, especially for the case study, I think it will help. If you're picking a top 30, a Dow Jones company, they on their own websites will have investor relations portions of their website. At least they should. And that is where you can find a lot of information as well.
That's right.
Just a helpful.
Yes, that's exactly right. So, and you are going to have to look up that growth rate for the company. That's part of the research side of this, and that's part of being a fun MBA student, is you have to look that up. In the case study, I'm going to give you the risk-free rate and the market return. You're going to have to look up the beta and the growth rate for the company. But again, the growth rate for you, for this analysis, I'm going to ask you to do the capital asset pricing model. So the growth rate is really meaningless because all you need to know is the beta of the company, and you can calculate that, okay? But down the road, in case number 2, you will have to look up the growth rate. And Yvonne said she just gave you some pointers on how to do that, okay? And we can talk more. Yes,
does that
Yvonne.
mean I have to pick a different company since I already did the cap?
I would hope you would be willing to do that, yes.
Okay.
but you got that down from your discussion post. If anyone wants to see that, Yvonne did it in her discussion post.
I'll take Disney.
All right, yeah, there you go. All right, James. There, yeah, that's not too cool either, but very good. Okay. All right, but that's how that works. Very good. Okay. So that's an important concept, and we're going to be using this a lot. Okay. Matter of fact, I was watching CNBC this morning, and they were talking about how the market is going to open up 500 points higher at the opening this morning at 6:30. And the reason it was opening up lower this morning is because the intrinsic values of stocks were very undervalued. In other words, people were crunching these numbers with their fancy computer programs and finding out that the true values of stocks were a lot less than the market. So a lot of people, were a lot greater than the market. So a lot of people were going in and buying stock this morning because they thought they were getting a buy. It was cheaper in relative to their true intrinsic value. So they were using this information to make that calculation, or brokers were using that information and telling their clients to put in buy orders today because they thought their stocks were undervalued. Buy them, cheap. All right, one last area of this that I want to talk about that will lead us into future work in regards to risk is this little synopsis right here: debt risk. Debt risk. All right. What is debt risk? Well, debt risk is a combination of the interest rate that you pay on a loan less the taxes you can write off some of that interest rate. All right. Remember, for individual taxpayers, you can write off interest on a mortgage up to $1 million loan. If you have a house with a mortgage over $1 million, you can only write off the interest of that up to $1 million of principal on that loan. But for corporations, they can write off hundreds of millions of dollars of loans and that interest on their taxes. So that reduces the actual risk of the loan because they get a tax break on borrowing the money. That's something that a lot of us individuals, of course, I don't know how many of you out there have over $1 million in mortgages. If you do, you got a sister I might want to meet. No, that's a joke. All right, but that's $1 million in loans mortgages is pretty hefty. But at the same time, corporations have hundreds of millions of dollars of loan, and they can write off the interest on those every year. So when I mean debt risk, it's called after-tax risk. Remember, the interest rate on a loan is determined by your credit risk. For individuals, it's your FICO score, your ability to pay back money. For corporations, it's your Moody's or Fitch's or S&P credit rating. AA, A-, B+, BB, C. Sounds like my grades in graduate school. All right, that's what that is. Okay, that's what the credit rating of your company. That credit rating determines the interest you pay on loans. All right, that's your risk in the market. And the interest rate, the higher the interest rate, means the market thinks you have greater risk in the market. Then your tax rate is your corporate tax rate. Right now, the corporate tax rate has dropped. 20% is a little bit conservative. It's usually around 22, 25% now, but I'm going to use 20%. So let's say a company has a 7% loan on some debt, and they have a tax rate of 20%. That loan's true after-tax cost is not 7%, it's 5.6%. It's 7% times 1 minus the tax rate. In other words, they get to deduct 20% of that interest on their taxes. Yes, they are paying the bank 7%, but then they get a kickback by the deduction of that interest on their taxes, and that's determined and driven by their company tax rate. So if I have a 7% loan, I take 1 minus 20%, that's 80%. 80% of 7% is 5.6%. So when I say to you, what is the true cost of debt? You have to take into consideration, here comes a big MBA word, ready to write it down. You have to take into the consideration the tax shield of the debt. The tax shield. How much you get to hide, or not hide, how much you get to write off, some companies hide it, how much you get to write off of the taxes that you pay on interest. So yes, I'm paying 7% on my loan, but my true after-tax cost is 5.6% because I can take into consideration the tax deductibility of the interest. That's an important concept in regards to debt. The cost of yes.
It's Roman. Sorry, I have a question regarding the write-off on the interest. So what if you have a interest-only mortgage? How much of that can you write off?
Remember, Roman, here you're talking individual taxes. Not too many companies have interest-only financing. Okay, so there you're talking about individual tax considerations. Okay, now if you do have $1 million interest-only loan, you can deduct that interest expense on that loan on your taxes. But for corporations, no bank is going to, here's what an interest-only loan is in banking, or in corporations, it's called a bond. It's called a bond. That's interest-only financing. A bond, as we talked about last week, you pay interest until maturity. So Roman, great question, but it's more of an individual question. Remember, if I have a bond, if I have a $100 million bond, I'm writing off that interest on my taxes as a corporation. I get to 20% tax deduction based on my tax bracket, my tax rate. Does that make sense?
Yeah.
Great, good question. I like that. But for some of us, and I know some of us, if you have an interest-only loan now, I'd be a little bit scared. But be that as it may, if you have an interest-only mortgage, yes, you can write off that interest every year on your taxes as long as it's on a loan of less than $1 million principal. Very good question. So a couple of points as we get ready to take a little break here, a couple points from chapter 6, because we're going to be using these points going forward in our case studies and other work down the line. If I want to determine what my required return on equity, owning stock, I can use the capital asset pricing model. If I want to determine my total after-tax cost of debt, I just take my interest rate on my loan and multiply it times 1 minus the tax rate to see how much I can deduct. I'm basically deducting 20% or 1.4% of 7%, and my after-tax true cost of debt is 5.6. 2 points to remember down the line, because we're going to be running into these in a variety of ways. That's why this is very important. So when we come back from break in about 10 minutes, we're going to take a look at the next tab that you see on that spreadsheet. We're going to take a look at a financial statement of a company, and we're going to answer these following questions about this information. What is the statement of cash flow? What is the current ratio, debt ratio, profit margin, return on total assets, price earnings ratio, and earnings per share of this company? The leading indicators or leading financial ratios, and we're going to explain them. We're going to determine the AFN model for 2020 for this company from chapter 12. We're going to determine their capital requirements in the next year using the resources of their financial statements in the future. Whew, pretty heavy duty. But this is what we need to know as financial analysts, as financial investors. We're going to take a look at what the bean counters tell us after we come back from break. So I'm going to turn back on the lovely music, and I'll see you all back in about 10 minutes at 7:10, and we'll pick up the next section of our class. See you then. Good job, Frank. Okay, we are back. If that music is a pain in the neck for you guys, you just let me know and I'll shut it off. It's my own little tidbits of keeping things a little bit saner in the world of finance. Okay, now we were talking about financial statement analysis. Now, I know numbers scare some people. The good thing about this, we don't have to prepare the numbers, we're analyzing the numbers. That's what accounting is all about, to prepare the numbers. What do these numbers tell us as investors, as managers, as strategists? What do they tell us about a company's performance? And what can they tell us about the future of a company's performance? That's what we're looking at. So in order for us to be able to make strategies and to understand our company, we got to know how our company is doing. Okay, we got to know how we're doing. It's just like in your own personal finance. I don't think if you didn't have much money in your checking account, not too much money in your savings account, and not too much liquidity, you would be probably wanting to buy a car these days. Okay? Because why would you accept more debt when the future is a little bit creepy, and at the same time you don't have much liquidity, and you're going to use up that liquidity by paying for monthly payments on debt? Well, companies is the exact same way. Companies, you have to track and monitor as whether they're investing or returning their assets on the financial history of the company. So let's take a look at this company. Again, this is a real company. I dropped a couple of zeros in the numbers to keep it sane. But this is real numbers from a real company through December 31st, 2019. And their stock price closed at $12.17 a share on December 31st. They had 250,000 shares of stock outstanding in 2019. Notice, they had 100,000 shares of stock in 2018. They issued 150,000 more shares of stock in 2019. That means money coming into the company. Their balance sheet has $3.5 million of assets, $2.7 million of current assets, and $836,000 of fixed or net fixed assets. Current assets are assets that have a life of less than 1 year. Cash, short-term investments, which could be mutual funds, money market funds, stuff like that. Accounts receivable, money that is owed the company, and inventories. Inventories of product that they have already produced that's sitting on their shelves or in a warehouse waiting to be sold. Their fixed assets are $1.2 million less the depreciation that has been made on those assets. That's how we get the net fixed assets. So net assets, total assets, are $3.5 million. Those $3.5 million of assets were funded by a little over $1 million in current debt liabilities, $500,000 of a long-term bond, total debt of $1.5 million. They had $1.6 or $1.7 million at par of stock that has been issued, and they had retained earnings of $296,216. The equity of the company is the stock plus the retained earnings, almost $2 million. $3.5 million debt or liabilities and equity. That's how the assets are funded. The definition of current assets and current liabilities is called working capital. I'll say that again. The definition of current assets and current liabilities is called working capital, short-term capital. Long-term capital investment is fixed assets. And usually those long-term fixed assets are funded by long-term debt, like bonds in this case. Now, to refresh your memories, retained earnings. Retained earnings is made up of the profits that you make less the dividends you pay out. I'll say that again. Retained earnings is the profits that you make less the dividends you pay out accumulated throughout the life of the business. If you think back to those wild and woolly days of accounting, oh, I can think about it now. Debits, credits, prepaid insurance, accounts receivable, unearned revenue. Ah, those were the days. But remember, one of the key things of accountants they do is they close the books. Every year, the books are closed. What does that mean? All revenue and expense accounts are closed to retained earnings. All dividends or owner withdrawals are closed to retained earnings. The retained earnings are the accumulated retained profits for the life of the company. A very important source of understanding. So that's the balance sheet. Excuse me, people, I'm gnawing on a lozenge here because I'm beginning to lose my voice. So I'm trying to save my voice here. So I'm sucking on a lozenge. So excuse me if it's making a lot of noise. Now, here's the income statement of this company for 2019. They had sales, cost of goods sold. That's what it cost them to produce their product that they sold. They had other expenses. They had depreciation, operating cost. Okay. They had total operating costs of that. They had earnings before interest and taxes. This is called operating profit. Sales minus operating costs equals EBIT. Another name for that is operating profit. Less the interest they pay on their debt, earnings before taxes. Their tax rate at this time was 40%. 40% of their earnings before taxes is $169,000. They made $353,584 in profit, of which they paid out 22 cents a share in dividends. 22 cents a share. The book value of their stock was $7.90. In dividends, 22 cents a share. They had 250,000 shares of stock outstanding at 22 cents a share, meaning they paid out $55,000 in dividends. Notice last year in 2018, they lost money, $95,000 in net loss, but they still paid a dividend of 11 cents a share. Why would a company pay a dividend when they lose money? Because they want to keep the shareholders happy. That's why. And they had probably the cash to do it. Even if they don't have the cash. A lot of companies borrow money to pay dividends. Scary, but true. So, how did we get to this ending $296,216 retained earning balance? Well, look at this little calculation in this cell here that totals to $198,584. If you take the net income of $253,584 and subtract out $55,000 in dividends, you get $198,584. And golly Gomer, if you add $198,584 to $97,632, the ending 2018 retained earnings balance, you get the retained earnings balance on the balance sheet for 2019. Retained earnings went up a net $198,000, which was the difference between profit and dividend. That's what retained earnings are. So there's our income statements for the period of time. Here's our balance sheet on a period of time, just like those statements told us in that opening video tonight. Now, notice in this column here, I've taken the deltas in all of the accounts. How these accounts have changed from 2018 to 2019. Notice that. That's called the deltas. Why are you doing that, Mr. Hassey, and putting those in nice little colors? Because if you remember from that video at the beginning of the class, and you probably don't, but that's okay. But if you watch that video again at our YouTube playlist, you'll see that the statement of cash flows is a combination of the income statement and the balance sheet and how these accounts have changed in the year. So we need to compute. I'm going to do this. I'm never going to ask you guys to do this. I'm doing this so you can understand what makes up the statement of cash flow and how important it is. The statement of cash flow is these deltas all put together to determine that cash, where did the $6,718 of delta cash come from 2018 to 2019. And here are those numbers here in this cash flow statement in this tab. Boom. Here they are right here. This is the cash flow statement for 2019, which is the third financial statement of the company. But for us as financial people, this is the most important statement because, let me get my prop here. Cash. Here it is, cash. Cash. Companies need this. Without cash, they ain't operating. Without cash, it ain't happening. If Disney doesn't have cash, no more Star Wars attractions at Disneyland. If Disney does not have cash, ESPN is going to be in trouble. If Coca-Cola does not have cash, they can't distribute a cola. All right? All kinds of different things we have to be aware of. Cash for analysis creates value. Companies producing cash flow creates that they can pay their bills. They can pay dividends. They can invest in new assets. They can pay their people. Without cash flow, trouble. Back to the balance sheet. Notice cash went from $7,282 to $14,000 in 2019. That's a delta of $6,718. Where did that money come from? Did it come from operations, financing, and investing? That's what these colors are here. Operations, financing, investing. That's what the colors represent, so you can see those. Here's the financial cash flow statement. The sum of these numbers equals $6,718. If you look at the cash statement, you want to make sure where is your cash coming or going. Notice they lost $170,536 on operations. They have positive $245,936 from financing. Why? They issued more stock. And 3, this is where they invested in long-term assets. This amount of money should match this. But in this company, it's not. This amount of money is covering the loss there. Operating cash flow should always be positive for companies. If it's not, you're draining value from the business. I'll say that one more time. Operating cash flow should always be positive, because if you're financing to pay off your bad management of operations, you're taking money away from new investments that can generate new revenue. I'm not investing in fixed assets or short-term investments, so I'm not generating new revenue sources. And why is the company have negative cash flow in operations? They made a $253,584 profit. That's cash flow coming in. They depreciated $120,000 of fixed assets. That's cash flow coming in. But here's the trouble. Notice back to the balance sheet. Accounts receivable went up by $246,000. Inventories went up by $429,000. If receivables and inventory go up, that means you're not collecting cash. You're spending it. You're spending it on new inventory. You sold product and its money's owed you. You have not collected the cash. So if you notice, the operating cash flow for accounts receivable and inventory are negative cash flows. Almost $675,000 of negative cash flow from receivables and inventory. Accounts payable and accruals. You borrowed a little bit more money, that's cash flow. Accounts payable is paying vendors. If you didn't pay vendors, you didn't spend the cash. You generated cash flow. But the sore spot of this company right off the bat is their management of working capital, their management of receivables and inventory. Now, this might be a one-time year thing, but this is why you go back and look at prior year statement of cash flows. If they're consistently having negative cash flow from the collections of receivables and the selling of inventory, somebody's not doing their job. And that's an important thing to look at. Notice back to the balance sheet. Common stock went up $1,220,000. That's the issuance of the additional 150,000 shares of stock. They took in that additional capital by selling stock in the market. And here's a problem I have. When you sell stock in the market, that's the most expensive form of capital fundraising. It's the most expensive. It's not like debt where you can write off the interest, like we just talked about before break. Equity and issuing stock, you have to perform or the investors are going to sell the stock and you're going to lose value. This company issued stock. When you issue stock, you should be investing it in new assets. You should be investing in new revenue streams. This company issued stock to pay off old debt and to cover their negative cash flow in operations. If I was a stockholder to this company, I would find a way of getting the hell out of this investment. It's showing that the company is not creating value because they're using new money to pay back old money. Not cool. So the statement of cash flow for us tells us a lot of information. How they're managing their working capital, current assets and current receivables. Where are they investing new capital? And they're certainly not investing it in short-term investments and fixed assets. That's very small. It's going to pay off old debt and cover those negative losses in cash flow in operations. This is what stockbrokers and financial analysts do every quarter, every month. When a company issues their new financial statements, like right now, what's the date today? April 8th. By April 9th, 8th. By Friday, April 10th, all the major American corporations will be releasing their first quarter financials. And all these analyst people and all these investing people and all these stock brokerage people are going to be pouring over this data and doing what we're doing now and looking for positive or negative management. Is the company doing better? Is the company doing worse? And is the company doing what they said they would be doing a year ago when they had to tell us what they were going to do? Welcome to the world of financial statement analysis. That's exactly what this is. You're going to be doing somewhat this in case number 2, but not case number 1. Don't worry about that. But this is important. We have a chat. Robbing Peter to pay Paul. Yeah, that's right, Michelle. This is how companies get in trouble. They have inefficiency in the collecting of the receivables or their inventory management. Welcome to the world of Macy's. If anybody knows Macy's. Macy's has inventory that they're not selling. They have collections that they're not making. All their cash capital is going to supplement the negative operations. So what is Macy's probably going to do within the next 2 years? close or be bought out or consolidate or do something. The retail industry right now is in a huge state of change. And it's even made more complicated by the coronavirus and what's happening. Any companies who are in retail, Yvonne, you are big time in retail with your Disney stores. And also you could almost say amusement parks are somewhat a retail type of venture. Disney's probably taking a long look at how they can make sure they're set up to manage those assets accordingly in an environment that's changing. Not too many people are going to be going to Disneyland in Anaheim this year. How does that affect the operations and the cash flow of Disney? And all companies are looking at that. So reading and understanding the balance sheet and the income statement is for amateurs. Understanding the cash flow statement are for MBA students, MBA managers, to see the comings and goings of capital out of the company. Very important. Broken into 3 segments: operations, financing, and investing. And notice dividends is a form of financing. You're now paying the shareholders their return on their investment. Be familiar with the cash flow statement. At the same time, going back here to our second question, what are these financial analytical terms and what do they tell us about the company? I'm going to put a couple of words here. Statement of cash flows tells us about a company's efficiency. I spell that right? Who cares? Financial ratios, financial analysis tell us about a company's trends, their trends. AFN analysis and capital budgeting tell us about a company's future capital needs. All right. These are what these 3 areas that we're talking about in chapters 3 and 12, they tell us about something. I'm going to highlight these here. There we go. Okay. We just looked at a company's efficiency. How are they managing their cash flow? They're not generating much cash because they're losing cash in operations and they're issuing stock to supplement that and also at the same time pay off some debt. They're not putting money into new investments that can generate new revenue. Remember, you need assets to generate revenue. A company is not going to grow if they're not investing in new equipment, new plants, new people, new products. You're going to get eaten up by the competition if you don't do that. This company is in a little bit of trouble. And in the statement analysis here, we're looking at trends. How has certain things changed from one year to the next? How do we look at compared to the industry, to the market we're in? And I'm concentrating this, like I told you last week, on page 119 of your textbook. On page 119 of your textbook, they give you all these definitions of selected financial ratios. And the ones that I have given in this template are the ones you need to be familiar with. All right? They tell us about trends. They tell us about how we rate to the industry that we're in. And they take a look at specific segments of the business. And if you have looked at page 119, look at page 119 because it breaks these analysis and these trends down by liquidity, asset management, debt management, profitability, and market value. Liquidity, asset management, debt management, profitability, and market value. By the way, everybody, I am recording this class tonight. Whew. Thanks, Mr. Hassey. This class is being recorded tonight, and the link will be put up tomorrow morning so you can watch this stuff again. Because yes, I want to hear that Harry Belafonte song earlier. I want to hear Mr. Hassey talk about investments. Yes, So it is being recorded. James, you know, you can smile every now and then. You got the camera on. There you go. Okay, thanks. You got a good smile. You look like you look like you're at a funeral. Smile. There you go. That's good. I like that. Okay. Now he'll probably turn off his video. So again, this is being recorded. All right. So let's take a look at the key liquidity ratio. It's called the current ratio. Again, we're looking at the data from our financials of this company, and we're looking at analysis about liquidity. The current ratio is current assets divided by current liabilities. The industry average is 1.25. This company that we're looking at is 2.58. That's not good. That's not good. Why? Because it shows that they got a lot of money tied up in receivables and inventory. All right. That's not good. It's called current ratio. It's a statement of liquidity. And as it says on page 119, it's current assets divided by current liabilities. Here's one you can bank on. In case number 2, that's next week, when you look at a real world company, one of the things I'm going to ask you is, what is the company's current ratio? That's a key financial indicator about liquidity in a company. The next one is coming from debt management. It's called the debt ratio. It's the relationship of total debt to total assets. The debt ratio. Total debt to total assets. All right. Notice 2018, this company was all 81% in debt. Thanks to issuing more stock, they paid off $900,000 of that debt, and their debt position went down to 44%. The industry average in their industry is most companies have 65% debt. So in this regard, this is a good thing. They have less debt than their competitors. Less debt means less interest cost. Less debt means you're better leveraged in the market. But now we got to go back to, why do we have less debt? We issued $1.2 million of stock to pay off that debt. We diluted the value of the company to make us look good as far as our debt ratio is concerned. Now, if we made a lot of profits and we used those profits to pay back debt, we'd be a lot better off. So this is kind of a mixed signal here. Yes, we have low debt position, but how we got there is we issued very expensive capital called stock. The next two are called profitability ratios or analysis. Profit margin on sales, net income divided by sales. Well, naturally, in 2018, they had negative profit margin because they lost money. By the way, when you look at this spreadsheet, you'll see the cell calculations in each cell, so you can see how I did that. So in 2019, they had a 3.6 profit margin. All right. In other words, for every dollar of sales, they made about 3.5 cents in profit. The industry average for their competitors was 5%, a little bit below industry average. The next profitability number is the return on total assets, which is net income divided by the assets of the company. In this case, it's 7.21%. That's telling you the return on invested dollars, assets. I'm making $7 for every $100 of assets. Okay. The industry average, 9.5%. But now you can see why I call these, why I call these trends. We're looking at trends over time. Many companies go back years to do this and comparing it to the industry averages. Let's skip down to earnings per share, another profitability ratio or a number. that a lot of companies, and you probably see this every day in the newspapers. Hey, last year we made $1 per share. It's called the earnings per share. It's net income divided by the number of outstanding shares of stock. In other words, for every share of stock, we made $1.01, of which, according to the financial statements, of that $1.01, we paid off 22 cents in dividends. Of the $1.01 earnings per share, we paid 22 cents of that in dividends. The rest we kept as profits. Right? But it breaks it down on a per share basis. $1.01 a share. Many corporations in the next week, and you'll be seeing this, and we're going to talk about it in class next week, is companies are going to announce their first quarter results, and it says, instead of saying we made $1.2 billion of profit, it's going to say we made $1.01 a share. They break it down on a per share basis, earnings per share. Now I'll skip up to price earnings ratio. Price earnings ratio is the stock price at the end of the year as a ratio to the earnings per share. Stock price divided by earnings per share. It tells you whether the company is, their PE ratio is competitive. The market here is 13, it is competitive, or whether the price of the stock is overvalued. If the PE ratio is over 30, that means the relationship to the market stock price and the earnings that that stock is going to be generating is too high. That means either one thing or two things. The stock is overvalued in the market, or the company is not making as many profits as they should be. The PE ratio is a relationship to stock price and earnings per share. This is used a lot by stockbrokers and investment bankers to gauge the value of stock in the market, the PE ratio. These are the 6 ratios from page 119 that you need to be familiar with. We're going to, Yvonne. I don't hear you, Yvonne.
Sorry about that. My mouse went dead. Can you go over earnings per share, how we got that number one more time?
Sure. If we go back to our financial statements, we'll see that, remember, the definition of earnings per share, because this is not on page 119, so that's why I'm going over it a little bit more. The earnings per share is the stock price, the net income of the company divided by the outstanding shares of stock. So if I go back to the financial statements, here's the outstanding shares of stock, 250,000 shares of stock. Here's the net income, 253,584. The earnings per share is net income divided by the outstanding shares of stock. In other words, the company is earning for every share of stock $1.01 profit. Naturally, the higher that is, nice. But it kind of summarizes all those big numbers, 253,584 and 250,000, into one little concise little number called $1.01. Notice the year before, in 2018, they had a earnings per share of negative 95 cents. Why? Because they lost money. Negative 95 cents. This year, it's gone up to $1.01. That makes them look pretty good. But it's not competitive or not very close to the market averages in their industry of $1.75 earnings per share. Again, trends and comparison to your competitors, the industry, gives you an idea of what's going on. Next week, in case number 2, you're going to be finding a real life company and doing this analysis. But you don't have to worry about that until next week. I have a chat.
Professor Hasse?
Yes, sir.
It's Roman. A quick question. The net income, is that the same as market cap?
No. I'll explain that to you in just a minute. Okay, hang on. Let me just say, the chat. Roman just asked, is earning per share the same as market cap? No, market cap is this number.
No, it's the net income. Is that the same as market cap?
No, market cap, like market capitalization.
Right, the market cap of the stock itself.
Market cap is equal to the stock price times shares outstanding. In other words, what's the value of the company in the market? So in this case, it would be 250,000 shares times $12.17. The market cap is $3,042,500. That's the market cap.
That's what the company is worth, right?
That's what their
how-
equity. That's what their equity position is worth. What the company is worth is their market cap minus the debt they owe. Right?
Right.
That's their true worth. Is the market cap is like right now we have basically 3 companies in the world that have $1 trillion market caps: Microsoft, Amazon, and Apple. Thank you. Those 3 companies have a market cap of $1 trillion. That's not mean they're worth $1 trillion. What they're worth is taking that $1 trillion and then minus all their debt. That's what they're worth. But in the market cap is a big word or a big thing because it tells us the value that the market is placing on this company as far as their equity value. The earnings per share is taking a look at net income relative for a period of time, usually 12 months, to the stock that it has outstanding. Make sense?
Yeah.
Good question, Roman. Market cap, we'll look at that a little bit later on in our course. Market cap is what the market thinks the company is worth. But let's say the market cap is $3 million and they have $1 million of debt, then their true worth is $2,042,005. You always have to remember debt has to be considered when you think about the value of a company, how much debt they have. Like Macy's right now, that's why they're looking at closing, because their market cap is closely approaching the amount of debt they have. Whoops. Not too much net equity in Macy's these days. Radio Shack, another one that's taken the dive. Other companies where their market value is equaling their debt, adios amigos. It's all over but the crying. But good question, Roman. Thank you. So that's financial statement analysis from page 119 of your textbook. An important part of analyzing. Not only understanding what's going on with their cash flow and the other 2 financial statements, balance sheet and the income statement, but also understanding how the company is trending with certain key relationships: liquidity, debt, profitability, and market value. I left out one area of this on page 119. It's called asset management. But in my opinion, in this class, we don't need to be too much familiar with that. But it is an important concept. Days sales outstanding. How long does it take us to collect our money? Inventory turnover. How fast do we turn over our inventory? Those are both very important strategic numbers to look at. But as far as this class is concerned, I'm not going to have you do that information. And here's why. These numbers are non-existent if you pick a financial firm, like a bank. Days sales outstanding and inventory turnover are not a very good indicators for a financial institution. So I'm using these numbers because they can apply to any type of company we run into or you select from the Dow. Okay, and our last analysis for tonight is this. Chapter 12. The firm would like sales to increase 15% in 2020. Using the Afn model from chapter 12, what additional capital would be required from external sources for 2020? Assumptions are that profit margin and dividend payout percentage will remain the same in 2020 as in 2019. Now let me explain this to you in English. In other words, all right, we're now beginning a new year, 2020, and we would like sales to increase 15%. We want to prove to the market we know what we're doing. We want to prove to our investors that we're growing the business. So we're going to put in 15% sales increase. Now, when sales increase, that means we need assets to fund those increases. Working capital, fixed assets. That's got to create that volume or sales increase. Now, how much new capital are we going to have to raise to fund a 15% increase? That's the question here. Future capital requirements. Now, let me stop there and let me give you an example from our own little personal worlds. All right. I have a salary. I make income. All right. I pay my expenses. I have some money left over. But next year, I want to buy a new car. And my income is maybe going up 3%. Is that 3% in additional revenue, income, less taxes, less all the expenses, can that give me enough capital do I feel comfortable with the risk to buy that new car? Because if I have to take on a loan, I'm increasing my expenses. If that 3% increase in my pay, less taxes, is not enough to supplement that additional cost of purchasing the asset, what the hell am I doing? All right? I shouldn't be doing that. Why am I making that mistake? Companies make this mistake all the time. So we use models to project out, all right, we're going to increase our business 15%. How much capital is that going to take? And at the same time, can we get that capital? Now, here's a key assumption here. Here's the AFN analysis tab right here. All right. It's going to tell us that we need $188,201 of additional capital from external sources. Now, what does that mean? Let me show you. Companies have three sources of capital. We've talked about that. Debt, equity, and profits. All right? Debt, equity, and profits. Those are three sources of legal capital besides the Godfather that a company can get money from. All right? Now, where do those three sources come from? Well, debt and equity come from external sources. You borrow money from a bank. You borrow money from bondholders. All right? Those are external sources of capital. Those usually cost a lot more money. The second thing is equity, issuing of stock. That is an external source of capital. All right? So let me write here, external. External sources. Interest, debt, and stock. If I have to go to borrow money from a bank and issue a bond, I'm going to acquire more interest. If I issue stock, I'm going to have to make those required rate of returns that my shareholders demand. But then we have internal sources of capital. What are internal sources of capital? Well, there's a part of debt that we create just by managing our business. It's called current operating liabilities or accounts payable. Accounts payable. Now, what's the downside of accounts payable? We got to pay it back in 30 days. But what's the good side of accounts payable? We have free money for 30 days. There's no interest. Where's my wallet? Bad choice. My Capital One card. Don't leave home without it, all right? Tonight after class, I'm going to go get a pizza. I have no cash in my wallet. I got $5, big deal. So what am I going to do? I'm going to use this credit card to go get a pizza tonight. Free money. It's not costing me a thing. Why? I don't have to pay this back for 30 days. I get 30 days of free money. That's called current operating liabilities. I get 30 days of free money. I better pay it off in 30 days or then it won't be free anymore. Interest and late fees and all that. But I can use this capital to buy things for free. Well, Mr. Hester, you're not getting a free pizza. Yeah, but the cost of money is free. I don't have to pay any interest. Anybody here ever hear of the company Walmart? That's how Walmart became, until Amazon came along, the largest retail company in the world. You know why? They created the idea in the 50s and 60s to build distribution centers to get the products to their customers quickly in their stores. By the time they got the products from their vendors and delivered it to the stores, they made profit off those products before they had to pay the vendors for the product. That's where that technology from supply chain management and why that's going to be a hot course to take in the next couple of years with the economy. How to get the product to the customers quicker with the lowest cost. That's why Walmart became one of the richest companies in the world, because they could deliver a product before they had to pay the vendor and make the money. Free money, accounts payable. That's an internal source of capital. And the second internal source of capital is a no-brainer. Profits. You make money. If you make money, you don't have to go borrow money. If you make a profit, you don't have to go and issue stock. If you make a profit, it's not free because you had your operating expenses, your opportunity cost, but internal sources are short-term debt, non-interest bearing debt, and profits. External sources are long-term debt with interest and stock. How a company manages these things sometimes is the difference between whether they're going to make money or lose money. If you can fund your business by this free money here and not have any interest or requirements, you're going to be successful. The problem is sometimes the true volume of a business means we have to go out and get capital anyways. But how you manage that is effective. The Afn model tells us how much external capital, right here, this company is going to need to obtain to make their sales increase by 15%. Again, now before I start freaking you all out, do not worry. I am not going to ask you to do this calculation in our class. Whew. Thanks, Mr. Hassey. So you do not have to worry about how I came up with the 188,000. I'm still going to run through it with you because I need you to understand that, remember, capital can be obtained by debt, equity, and profits. But within those three, you have some that are external, going outside the company, and some that are internal, generated inside the company. The internal sources are the cheapest. The external sources are the most expensive. All right? When a company doesn't make any money, they have to go outside and get capital, and that's when it starts getting a little dicey, expensive. If I'm not making enough take-home pay, I got to use my credit card. If I can't use my credit card, I got to get a loan, or I got to borrow from mom and dad, or whatever. I have to go outside to meet my needs internally. Same thing with companies. So here's how I calculate that problem. If sales increase 15% and I'm operating at full capacity, which we're assuming here, that means my asset base, this $3.5 million, is going to increase by 15%. So that means I'm going to have a delta. If I want to increase sales by 15%, I got to come up with almost a little bit over $500,000 in new assets to fund that growth. Where is that $527,000 going to come from? Well, internal sources. My current operating liabilities are $739,000. Here they are right here. This number, accounts payable and accruals. That is non-interest bearing debt. Mr. Hassey, notes payable is part of current liabilities. Why aren't you including that? Because notes payable is outside the company. It's interest bearing debt from a note signed with a bank. It's current because it's due in the next year, but it's still interest bearing debt. It's not current operating liabilities. So this is where the 739.8 come from, right there. So if that is 739.8, again, the assumption, if sales go up 15%, that means $110,970 is going to be an increase in current liabilities in 2020. That's going to pick up part of the tab of that $500,000. In 2019, my profit margin was 3.6%. In 2019, my dividend payout was 21.69%. That percent. I'm going to maintain those levels in 2020. Well, if my sales were $7,035,600 in 2019, that means a 15% increase in sales is going to make sales increase by $1,055,000. 3.6% of 7 million was our profit margin or profit in 2019. 3.6% maintain that same profit margin of the new sales amount. That's my profits next year. If I pay out 22 cents a share again next year, there's my dividend payout with the increase of revenue. That means I retain an additional, my retaining amount is going to be 228,372. So I'm generating internal sources of accounts payable, that number. I'm generating internal sources of profits I retain, that number. And look at the formula here. It's taking my delta of my assets, subtracting out the delta of my current operating liabilities, and subtracting out the delta of my retained profits. What's left? 188,201. What I have to go external to raise money. So if I want to raise my sales and my sales volume by 15% in 2020, I got to go out and find $188,201 of external financing to fund this increase in assets that will make that happen. Whew. People do this for a living and get paid bucho bucks, trust me. But here's what you have to get out of this. Remember I said earlier, you don't have to worry about this calculation. What you do have to worry about is this. There are two sources of capital for a company. One source is outside the business, banking, bonds, stock. That's money outside coming in. Very expensive. The second source is internal capital, generated by accounts payable increases that you have to pay off in 30 days, but you get 30 days of free money, no interest. And naturally, you're funding some of your operations by the profits you retain during the year. Watch this. It's a juggling act. I can't do this very well with this camera, but it's a juggling act. Where am I going to get my money to be successful? Is it going to come from outside expensive sources? Oh no. Or is it going to come from inside sources? Finding the balance of that within a company is called the capital structure. Write that down. Finding the balance of how to finance your operations is called capital structure. Where is the money coming from? Internal sources or external sources? That is a key coming out of our lecture tonight. So, it's 8:05. I'm doing pretty good. Let me review this. We looked at the financial statements of a company. What's the balance sheet? What's the income statement? And then we took a look at what is the cash flow statement. From that analysis, we learned that this company specifically has some operating cash flow problems, mainly the result of poor collections of receivable and inventory. We also saw that they issued new stock mainly to pay off debt and to reduce that operating cash flow. Then we took a look at the trend analysis from page 119 of your textbook, taking a look at all 5-6 key issues, key analysis, how to calculate them, what they mean, and how we use those as seeing how we stand in our industry and to the past operations of our company. Then we took a look at looking into the future of how we're going to generate new growth, a new return, and where is that funding going to come from? The Afn model gives us a breakdown of external sources and internal source needs into the future. Geez, I don't need to borrow money next year. My company's giving me a $50,000 raise. I can buy that new car with my raise and get cheaper loan from a bank. But I'm not going to get a raise next year. I'm going to have to either go out and get a hefty car loan, or I ain't getting a new car because I got to go outside of my world to get new capital. Well, this is even more important for companies when you're dealing with millions of dollars, hundreds of millions of dollars. How can you generate competitive growth if all your money is coming from the most expensive side of financing? Borrowing from banks. You guys know this. When you go to a bank, they got you by, excuse the expression, ladies, they got you by the short hairs. Why? You can't negotiate. Your credit is going to drive your interest. Your credit is going to drive your maturity, how fast you got to pay it back. You can't negotiate that. If I have to go out, if I'm a company and I got to go into the market and I have bad credit, I can't get cheap rates. It's going to be very expensive to issue stock because the investors are going to want to be compensated for that high risk, that high beta. Whereas if I run my business efficiently, I can draw on internal sources to fund most of my growth, and that doesn't cost me a nickel. The companies that can do this the best are the ones that survive, right? And it all relates to cash flow, status in the market, efficiency measures, and your ability to generate internal sources of capital and not external. That's the subject of our lecture tonight on Chapter 3 and Chapter 12. This sets us up now, knowing these things. Next week, we can begin to look at strategies and how our financials, how our history, how our trends, how the way we finance will drive what type of assets we can purchase. We can manage our financial resources. That's where we start doing next week. So, pretty good, huh? Okay. I'm getting punchy. This is my third, I think you guys know this is my third class today. So I'm getting a little, okay. So let's go to this. I want to show you this. All right, hang on. We're almost done, guys. We're almost done. Here we go. Angel, what kind of sweatshirt you got? Angel, is that a Chicago Cubs sweatshirt?
Unfortunately, it's not Cubs, but it is Chicago.
Are you from Chicago, Angel?
No, all my mom's family is, though. So we actually had a family reunion this last summer, and that's when I got there.
Isn't Chicago a good town? Town, nice place, right?
Yeah,
Did you have deep dish pizza?
Of course, and Chicago dogs. And
I'm not a big fan of deep dish pizza, but the Chicago dogs are good, I have to admit. There's a place in Orange County here that have Chicago dogs.
Really?
I can't remember. Yeah, I can't remember the name of it. I'll look it up for next week. Okay, we're getting off track here. If I, let's see, let's bring this up. That's not what I want. Here we go. All right, here we go. Here's our old Blackboard site. Now it's past the 8 o'clock witching hour, And if you go to case study file folder, you will now see your first case study in this class. It's called Capital Financing Review. This is due next Tuesday at 9 o'clock. It's given to you in 3 files, but really only 2 files. These 2 files are the same. It's a PDF file and it's a Word doc file. And then I give you a listing of the 30 Dow Jones Industrial companies currently in the market. I give you a listing. All right. This is worth 15% of your grade. The format is your choosing. I'm not telling you what type of file. Next week, I'm going to tell you what type of file to put it in. This week, it's your choosing. You can put this in a Word document. You can put this in a PDF document. You can even put some of your answers in an Excel spreadsheet. You can give me 2 files. You can give me 1 file. It's your choosing as long as you answer the questions accordingly. Now, here is what it looks like. If you download that file, whoop, here we go. If you download that file, this case study is broken down into 4 questions, all concerning capital financing review. The first question relates to some of the work you did last week on your discussion post. It's some time value of money calculations. All right? Kind of similar to what some of you used in your examples last week. Question number 2 is talking about debt, bonds. How are bond ratings determined? Why do some bonds sell for less than their face value? We talked about that last week. Some questions there. Then question number 3 is your time to do a little internet research. Question number 3 is looking at stock valuation and risk. It talks about General Electric last year being dropped from the Dow Jones Industrial Average. General Electric is no longer the company that it used to be. Angel, what the hell's that dog there doing there? Get the dog out of there. Okay. Tell that dog to go back to Chicago. All right, so General Electric was dropped from the Dow last year. It was replaced by Walgreens. Okay. The decision to drop General Electric, an original member of the Dow that had been part of a 30 stock index continuously since 1907, marks the latest setback for the conglomerate that once was the most valuable U.S. company, but has been hit hard in recent years by the unraveling of its finance business and competitive problems. General Electric stocks have tumbled 55% over the last year, erasing more than $100 billion, and Roman, you asked this earlier, in market cap wealth. Let's say you're an investor in General Electric. Please give me examples about what this means in relationship to an investment. If you purchased 100 shares of General Electric in January of 2002, how does that relate to you as an investor by this sudden drop in General Electric's value? So here's what you're going to do. You're going to need to go and find the General Electric stock on January 1 per share 2002. And you're purchasing 100 shares. How has that changed to today? So this is like a quantitative analysis. You're looking at numbers and seeing how has it changed over the last 18 years. And give me an example of why General Electric has unraveled in the perspective of you being an investor. The final question is risk evaluation. Select a company from the Dow Jones Industrial Index and prepare a risk analysis, Chapter 6. Your risk analysis should be find the credit rating of your company. Look up the credit rating. Find the beta value. We saw that earlier tonight. Determine the capital asset pricing model return on equity investment using the risk-free rate as this amount and the market risk return of this amount. Determine the capital asset required rate of return using these assumptions. You don't have to worry about the growth rate of the company. Once you find the beta of the company, you can calculate this number. And once you calculate this number, once you calculate and find the credit rating and the beta, give me a risk analysis in your words of the company. Is this company a dog with fleas? Or is this company competitive in the risk market? Is this company got a decent rate of return? What do these numbers tell you in your words about a risk analysis of this company? Isn't this fun? MBA stuff, it's cool. All right, so first of all, let's talk about the Dow Jones Industrial Company. Let me get this list up here. Okay, here's the file that gives you the top 30 company, or not top, the 30 companies that make up the current Dow. 3M, American Express, Apple, Boeing, all the way down to that. Now, I don't want, we have what, 9 students, 10 students in this class. How many we have? Where's my list? Oh, here we go. We got 9 students in this class. I don't want everybody to pick Apple. I don't want everybody to pick Disney. I want everybody to pick a different company. Now, how do we get around that? Picking a different, yes, where is this here? Chat. Tom, I told you earlier that I want the file type is your choosing. You can either do a Word doc file, you can do a PDF file, you can do a spreadsheet file for some of that, or you can do a combination of both, Tom, okay? Good question. Thanks for asking that again. Let's see here. Another chat? No, we got it. Okay. So now let me go back to here. Excuse me, guys. I'm getting the files here. So you have your Dow, and if you go to your Blackboard, oh, Jesus. Here's your Blackboard. So what I would like you to do here in Student Discussion Forum, as soon as you pick your company, I want you to put it, this is going to say week 3, and I'll change that right now for you. This is going to see week 3, and I want you to create a forum and tell me what company you decided to pick, okay? So go to week 3 and open up a forum and tell me Yvonne picks this company, Tom picks this company, James picks this company, Michelle picks this company, and tell me what company so you all can see what your fellow students are doing so we don't have anybody picking the same company, correct? So I want you to tell me in the discussion forum which company you're choosing and tell me so we don't have everybody doing the same company. I want different companies. So I'm sure as soon as class is over, you're going to run to that file and say, I want Apple or I want Disney, all right, whatever. So, but I don't want the same file, same company. So if I see that, I'll send you an email saying somebody's got to pick another one. Yes, James, week 3 questions and comments. That's where you place your name of the company you're doing. It's because I want everybody to pick a different company because that's fair. It's not fair to everybody if you have 2 people doing the same thing. All right. So that's our quiz. Now, back to this again. What am I doing? Did I just end the meeting? Hang on, guys. There we go. Okay. God, I thought I lost you. My screen went blank. Fear. All right, back to Blackboard. So in Blackboard, in case study, what you want to do is you want to download these files and begin your work. And then just like you're doing with the discussion forums, you're going to open up this file folder next Tuesday and upload your file here. You're going to attach your files to here, and then you're going to hit submit, and then I can grade your work. No, nothing is to be sent to me via email. Everything posted to Blackboard. And I don't want to hear, you guys are professional students, I don't want to hear, Mr. Hassey, it's too difficult to do this. I'm going to send you an email. Tough darts. Post it to Blackboard. If you can't do it, send me an email, come to office hours, and I will help you load up your files. But I don't want any email. I get 350 friggin' emails a day, and if you send it to me in an email, I'm going to lose it. I'm not going to find it. All right. All right. There we go. Darlene, everything all right? All right. Thank you. Good. All right. Alice, I haven't heard from you. Everything okay? Alice, everything all right? Give me a thumbs up, Alice.
Can you hear me now?
I can hear you now. I just want to make sure. You've been quiet tonight.
Just a general question. So some of those answers, you need like a long explanation, like some of those calculations, like number 3, where we calculate the rates of return and some of those.
Alice, I'm going to give you a snobby answer to that, and I apologize in advance. The snobby answer is COLLEGE MBA. You figure that one out, okay? Okay? You have to determine. You're at this level, I shouldn't tell you what is a proper length of an answer.
Mm-hmm.
All right? Now, naturally, one sentence is death, all right? So, but you determine how you completely, in your interpretation. Now, if you can answer a question in one sentence and I go, oh my God, this person knows what they're talking about, then that's fine. But I highly doubt most of these questions can be answered in one sentence. So now, Alice, I will give you this. If you think, and this is one of the good things about this class, is that if you feel your answer is sufficient, but you want to throw it by me before you post it, I'll let you know whether it looks and is sufficient. So you can say, Mr. Hassey, this is what I've done so far in this. This is what I've done. What do you think? And I won't tell you whether it's right or wrong, but I'll tell you, you know, Alice, go ahead with that analysis. It looks good to me.
Okay.
Fair enough?
Mm-hmm.
Okay, so you can screen that with me before that. Now you can send that through me through email. You don't have to post it, then repost in the Blackboard. You just post your final work to Blackboard. But if you want to email me during the week or come on during our office hours, our office hours are Friday from 1 to 3. If you want to say, Mr. Hassey, am I answering question 2 okay on this? We can talk about that in office hours or any other vehicle. That's no problem. Fair enough?
Okay. Yes.
Good. Okay. So that's where we stand. We covered a lot tonight, a lot of financial stuff, but that's where it's all condensed in that one Excel file. I'm going to repost that file after class with all the little colors and highlights so to match my lecture. And I'll repost that as soon as we're done here. And again, remember, I am recording this session, so you can go to the link in your Zoom links or go to our YouTube website playlist for 635 Spring, and you can go to that playlist, and that recording of that class will be in that playlist in YouTube. And you can show that playlist to your homeboys. Hey, you want to see my class? See what I'm doing? This guy's a real fruitcake. You might want to check this guy out. So you can show that to your homeboys. One last time, any questions?
Yes, sir. I got one.
Good, Jesse.
As far as the when you were going over the trend analysis,
Yes, sir.
where did you get? And I'm sorry if you already covered this, but I might have been running. Where did you get the industry averages for the analysis?
I went to a source of my own sources, and I'm going to give you that source next week. Any of you ever hear of the Wilson Library at the University of Laverne? Any of you ever hear of Hoover Online at the University of Laverne Wilson Library? Hoover Online will be your source for that information, Jesse. And next, if you look in our YouTube playlist, I have a video in our YouTube playlist for our class about how to use that service at the library. But if not, we're also going to review that next week. I'll review that. That's going to be your source for the data of industry averages, Jesse. Okay?
Thank you very much. Appreciate
Very
it.
good. Very good. But I want you worry about that next week. Don't worry about that now. We'll talk about that also next week. Any other questions? Yes, Darlene. No? Tom? Good man. All right, then that's it. You have the video. I'm going to update the Excel spreadsheet. Good work, guys. Good work on the discussion post. You guys are really doing well on that. And this is our first case study. As you can see, those 4 questions are going to maybe take a little bit of time. So balance and, make sure you're okay with your studies and fit this all in. And I'm going to be honest with you. If it comes to Tuesday afternoon and you send me an email or a text and say, Mr. Hassey, can I get an extension for a day on this? Can I post this on Wednesday? Can I post this Wednesday night? No problem. Okay. If you need an extension for the due time on Tuesday and you need some extra time, just let me know. Just don't assume that you're going to get it, but just let me know. You don't have to tell me the reason why, just so I know, because here's why. At 9 o'clock next Tuesday, the Blackboard shuts down. In other words, you can't post after that hour. Okay. So if I know that you get an extension, are going to be late, I'll just go into that and free it up for you. So you won't have it, so you won't be blocked out, because then students freak out. Wait a minute, I can't post my work. So I can unblock that so you have an extension. But if not, right now it's set for that 9 o'clock hour, and it will shut you out if you come in at 9:01. So just so you know my little tricks and trades there, all right? But if you need extra time, that's no problem. It won't affect your grade whatsoever. Remember, I want you guys to learn. I don't want you to be stressed out by making deadlines. That's not a big deal here. Other professors think so, I don't. Anything else? Any other questions? Let me check the chat room. All right, we're all cool there. All right, guys, be well this next week. Remember, I have office hours on Friday. I'm available all weekend if you need any help. And good class tonight. We covered a lot of material. And be careful. This is a big week here in Southern California this week and next. Don't go running around outside hanging into all these disgusting people out there with all these diseases. Stay at home or make sure you're covered and take care. All right, everybody. Have a good week. We'll talk to you later.
Bye. Thank you.
Bye-bye.
Thanks, everyone. Bye.
Good night.
Good night. There we go. And adios from Claremont.